When I told people I trade without a stop loss, they absolutely lost their minds. I'm talking fully blown panic. Even when I showed them cold hard proof that it works, I was being called a gambler. And the truth is, it's a very calculated approach, trading without a hard traditional stop loss. Not a lot of people talk about it online. The reasoning? I don't know. At any rate, it's called drawdown control, and we're minimizing our risk, and instead of taking those big 1% losses, we're going to average out of our positions just as we averaged into them. We're manipulating our average price and bringing it with us as the move progresses. In this video, we're going to be looking at how you can use it effectively. We'll also be looking at how different drawdown control metrics will affect your profitability and, well, drawdown. Let's get into it. Now, before you flame me in the comments once again, I do have a stop loss strategy. I still use stop losses on different pairs. And no, this won't work with crypto. Well, I mean, it might. I've just never tried it. All right, that's enough yapping. So have a look at my other videos and see actually how my strategy works. We have entries and exits and all that other shit. This video is simply drawdown control. Let's get into it. I think the first thing I've got to do is make my account go into drawdown so you can see it working and I can explain what's happening as it's happening. In other words, I'm just going to over leverage the fuck out of my account. Let's risk 1% over 1 ADR. 1. There you go. Now, what we're going to do is when a single position goes into 1% of drawdown on the account, we're going to close off 40% of that trade. So it's like a 1% stop loss, but instead of closing 100% of the trade out, we're going to close 40% of it. And I've got pretty aggressive entry criteria, so we're probably going to get into some fuck drawdown, but let's see how it goes. All right, we've put a buy in because we're stretched down in the higher time frame. Look at my other videos. We got an entry. We've just hit take profits. What the fuck? Show me some drawdown. Stop making money. What the fuck? It's just making money. Oh my fuck, because I put the leverage up. Oh my fuck, because I'm risking 1% and I'm targeting 0.1, it's just going to be in and out very quickly. Wrong settings. Let's change it up a bit. Let's wait for 1%, alright? Now it's definitely, it has to go in drawdown, alright? It's not going to close me out too early. Let's see it now. So this is like what I was talking about in my previous video. If your targets are too far from your entries, you're probably going to go in more drawdown and you're going to have to take more drawdown control losses. But let's just see it do some drawdown control. So it's not hit its target. Fuck's sake. Let's see drawdown control. We're in a short. Alright, this is fucked. It's just making money. Let's try a different pair. Alright, let's try USD CAD, because I know that's a bad pair for it. Alright, take 3, USD CAD, high leverage, let's get into some drawdown. Alright. Alright, there you go, drawdown control. Alright, let's analyze. So remember, we're dollar cost averaging when we're mean reverted up. So the higher time frame. 75. Alright, so on a higher time frame, we probably look like this. So we're going to start averaging in for that pullback. Take profit. Very nice. Right now, from a higher time frame, we look like this. We added a position, a sell order. We're expecting price to come down. Price has moved against us, so we've added a second position. What that's done is put our average price in the middle of the two. Actually slightly closer because I'm using bigger lots, all this mathematical shit. To keep it simple, I'm just going to say we're right in the middle, alright? We are right in the middle of these two positions right now. Average price is dead in the middle. This first position has gone into 1% of drawdown. What I'm going to do is close off 40% of the first position. What's that going to do? That is going to drastically bring our average price closer to where the actual price is at the moment. we're manipulating our average price and bringing it up with us. This is just an example, and there's obviously better ways to do it, because if you leverage too much like I just did to show you guys, you're just going to keep taking these drawdown control losses. It's not a smart way to trade. So as we're averaging into the market, we can also average out of the market. We're just bringing our average price with us. We're keeping our average price close to the actual price. So when we have that snapback, we're expecting, because we're stretched on a higher time frame, we can get out with a profit, minimize our losses by using drawdown control or an adaptive stop loss. The way I see it, there's three main ways of taking a loss on positions that aren't working out. Number one is send a loss in money. If you go into X amount of drawdown, you're going to close out part of that position. You're going to take some risk off the table. And with this trading approach, you're entering with such tiny lot sizes. Because remember, you can always average more in, but as soon as you average out, you're taking a loss. Number two is send a level. That price moves against you if we just start taking positions off. You can use ADR for this. Number three would be if a position goes into a certain percentage that you start feeling uncomfortable, that can be your cue to start taking losses or removing risk from the table. It's important. You can't just cross your fingers and your toes and hope that price is going to come back, because it may just never come back to your average. So you're going to move your average with you. So it is kind of a stop loss, because we're closing a part of our position out, not the whole trade or the whole position. This is our way of scaling out of the position, the same way that we scaled into the position. Taking slight losses is our way of assuming that we're still right on the direction, but we're just a little wrong on the timing. So instead of using a hard stop loss and trying to time the markets perfectly, this approach is good if you don't want to time the market perfectly. So if we're in a 3% loss, why would we close off all 3% and take a 3% loss when we can close off maybe say 1% and wait for the rest to play out? So you'll be sitting in drawdown most of the time with this trading approach, and that's fine. That's what your risk is. That's what you're risking. My open trades will be in drawdown virtually all the time, but my closed positions are rarely ever red. This is because I'm not taking stop loss hits every day. It's your job to find what percentage of drawdown you feel comfortable in. As soon as you start feeling uncomfortable, you start making stupid decisions. When drawdown becomes uncomfortable, one of these things is happening. Number one, you're in too many pairs. If you're trading $3 crosses and you're trying to average into them, you're going to be in triple the drawdown potentially, because they're going to move similarly. They're going to move similarly to each other. Number two, you're adding too big of a lot size, or you're adding too many positions too close to each other. I've talked about this in another video. And number three, you're just completely wrong. Price just moves and moves and moves against you. We're talking later in this video how to deal with this. Obviously, your level of pain tolerance is different to mine, and it's different to the next person. I don't know what it is, and only you can feel it. You need a mechanism or rule set to trigger to tell you that you're in too much drawdown and that you need to take losses. You can do this manually or set it up automatically using an EA. We can reduce pain by looking at the profits we've been gaining over the last weeks, months, whatever. Remember, this is a business. You make business decisions, and sometimes they cost you. Taking these losses is required because you're removing this risk of the table, and it can help you sleep better at night. So what happens when we're really wrong? These big squeezes happen, and these happen typically due to some fundamental reason or news that is making price accelerate away and not look back. These usually do reverse at some point, but for now our positions are negative and getting more and more negative every day. Now this will hurt you, and you'll see no way out, but you treat them the same way as any other position. You'll take losses, and they'll wipe out days of profit, but these are rare. This is the importance of trading tiny lot sizes. The more leverage you use, the more likely you're going to find yourself in uncomfortable positions. This brings us on to aggressive drawdown control. This is accelerating our exits, but we are using a hard stop loss. Sometimes you'll have an opportunity to take larger positions and get out of temporary wrong trades faster. When you feel uncomfortable in a trade, you can either enact normal drawdown control like I just said, or you could elect to dig your way out of it quickly with the added bonus of making some nice profits. So aggressive drawdown control uses a stop loss. Remember those things I told you not to worry about? Well, they still have a use. Let's just say, for an example, we entered a long position because the RSI was extended below 30. We entered with a 0.05 lot size, so we're stretched down. We entered here. Price has continued to push against us to the point where we're in 4 more positions. So now in total we have 5 positions in this trade, totaling 0.25 lots. We're still waiting for this position to go long, but our risk has increased. Since price has continued to move against us, the RSI in the higher time frame is now sitting at 15. It is massively overextended and it's due to snap back at any point. Now, aggressive drawdown could be a viable option for us, but we may use something else like a strong level of support that's coming up to give us another confluence to add a nice big position at the bottom with a stop loss. The aggressive drawdown uses a traditional stop loss below the low or the high. Our position that is in 0.25 lots and in drawdown, now it's uncomfortable for us. So we enter our aggressive drawdown control position roughly a third to a half of the total size. Taking a calculated risk, we might be at a strong level of support or resistance, as well as having a massively extended RSI. So we're expecting this move to happen soon. So it was extended even when we first entered, now it is massively extended. It's due to pop at any moment. Let's say we entered half a position. We entered another 0.12 at the bottom of our 5 trades. So we enter our 6th, 0.12. And by doing this, it's brought our average price all the way down. So we just need a little move for us to be break even and in a bit of profit. 3 outcomes of using aggressive drawdown control. Let's have a look at them. Number 1 is we have that snapback and we just get out with a break even. Number 2 is that we come back up to our break even and we close our bottom large position and use those profits to close off some other positions as we wait for the move to carry on, because we're expecting it to still come up because it's so massively extended. Number 3 hurts the most, and that is that you add your aggressive drawdown control at the bottom and price just continues against you. So you're going to take a loss because you've had your hard stop loss. Your stop loss is going to hit. You're going to take a loss on that trade. So that's going to hurt a bit, but you're just going to have to wait for it to come to another level of support or see some bullish structure come into play. And then you can try again for a second aggressive drawdown control position. This isn't something you can backtest because manually you as a trader, you're deciding to do this. You're deciding to do this aggressive drawdown control because you want to get out of the position and you can see the support or resistance level coming up. There's a fine line when it comes to taking too much drawdown control too quickly and not taking enough drawdown control where you go into bad drawdown. And if you're not taking enough drawdown control, well, you're going to blow your account. You have to backtest years and years and years of data through multiple market conditions, and you have to forward test because you need to know what drawdown you're going into using your strategy. You need to find a level of drawdown where you're comfortable trading in, because if you get in too much drawdown, you're going to make stupid decisions. On the subject of backtesting and finding your own profitable strategy, my next video is going to be permutation testing. Pretty much doing hundreds and hundreds of different variations for dollar cost averaging. We're going to be having a look at the differences in risk, adding distance, single targets, position targets, drawdown control, everything. How you can do hundreds and hundreds of tests. So if you want to stick around and see the next video, like and subscribe because I've got lots more videos coming out. With that being said, cheerio.